Assalamu alaikum. I'm Aisha Ashraf, Assistant Professor, School of Business from Asian University of Bangladesh. Today, I will discuss the forward market, future market, and option market. So now I'm going to discuss what is forward market. A forward contract is an agreement between a corporation and a commercial bank to exchange a specified amount of currency at a specified exchange rate on a specified date in the future. So a forward contract, that means is the agreement between a corporation and a commercial bank, and that should be exchanged a specified amount of currency at a specified date. So the most commonly, the common forward contracts are 30 days, 60 days, 90 days, 180 days, and 360 days. The forward, when MNCs anticipate future need or future receipt of a foreign currency, they can set up forward contracts to lock in. That means in forward contract, there must be exchange in a lock rate, or the rate should be locked. Forward contracts are not normally used by the consumers or small firms. Like spot rate, there is a bid or ask spread on forward rate. The rate at which the bank sells or buys forward contract are known as ask rate and bid rate respectively. That means ask rate means sales price and bid rate means purchase price. So the spread is the difference between the purchase price and sales price. That means the ask rate and bid rate. So we can get the spread, the difference between the ask rate and bid rate. So if the forward rate exceeds the existing spot rate, then it contains a premium. And if it is less than the existing spot rate, then it contains a discount. So the premium or discount is normally calculated on an annual basis. So there is the example how to calculate the forward rate, forward premium or discount. First of all, you can see that spot rate is $1.681 and the 90-day forward rate is $1.677. So the forward premium or discount is forward rate minus spot rate divided by spot rate into 360 days divided by number of days. Here the forward rate is $1.677 minus spot rate is 1.681 divided by $1.681 into 360. That is a formula in a, that is already set up in formula, and forward rate time maturity is 90 days, so we can divide it 90 days. So we can get the forward discount is minus 0.95%. The result is minus 0.95. That means we get the discount. If it is positive, then we will get the premium. Forward rate typically differs from the spot rate for any given currency. If the forward rate were the same as the spot rate and the interest rates of two currencies differ, so it should be possible for some investors to use arbitrage facility. So again, I can say that when the spot rate and forward rate and spot rate are equal, but the interest rate differ, then investor can get arbitrage facility. So the premium reflects the difference between the home interest rate and the foreign interest rate, and as they also prevent the arbitrage also. So what is non-delivered forward contracts? Non-delivered forward contracts are forward contracts whereby the currencies are not actually exchanged. But in forward contract, the currency, in delivered forward contracts, the currency are actually exchanged. That is the main difference. Now we are going to discuss the currency future market. Currency future contracts are contracts that specifying a standard volume of a particular currency to be exchanged on a specific settlement date. Typically, the third Wednesdays in March, June, September, and December. So, what is the main difference of forward market and future market? The main difference is that in forward market, the currencies should be exchanged, but in future markets, the volume of particular currency to exchange on a specific settlement date. Now, the currency futures differ from the forward contracts in many ways, and these are the factors. Number one is size of the contract. Number two, delivery date. Number three, participants. Number four, security deposits. Number five, clearing operation. Number six, marketplace. Number seven, regulation. Number eight, liquidation. And number nine, transaction cost. So these are the determinants that we can differentiate between forward contract and future contracts. Now the difference is, the first difference is size, depend on size of the contract. In forward contract, the size of the contract is tailored to individual need, but in future contracts, that is standardized. The delivery date in forward contract is tailored to individual need, but in future contracts, the delivery date are standard. And in forward contracts, what are the participants? The participants are mainly banks, brokers, and multinational companies, and public speculation not encouraged. But on the other hand, in future contracts, in future markets, banks, brokers, and multinational companies are the main participants, but qualified public speculations are encouraged. Security deposits. In forward contracts, compensating bank balance or lines of credit required, but in future contracts, small security deposit required. What are the clearing operation? In forward contract, handling contingent on individual banks and brokers, so there is no need to separate clearinghouse function. But in future contracts, that handled by exchange clearinghouse and daily settlement needed to the market price. In forward contracts, the marketplace over the telephone worldwide work, but in future contracts, they need central exchange floor with worldwide communications. In forward contracts, that is needed self-regulating, but in future contracts, there is needed a commission to monitor or to control the future market. So the commission name is Commodity Futures Trading Commission. Example is National Futures Association. In forward contracts, what are the liquidation? Most settled by actual delivery or some by offset. That means if the forward contract is purchased, then that can be settled down by selling. If the forward contract is selling, then that can be offset by purchasing. In future contracts, most by offset, very few by delivery. So in forward contracts, what are the transaction costs? That's set by spread between banks' buy and sell price. We have already discussed that we can get a spread between the difference between the buy price and sell price. And in future market, the spread is negotiated brokerage fees. Now I'm going to discuss briefly currency future market. Normally, the price of a currency future or the future rate is similar to the forward rate for a given currency and settlement date. Otherwise, there exists the possibility of making profit. However, like forward rate, future rate is different from the spot rate. If a firm holding a future contract decides before the settlement date that no longer wants to maintain such a position, so it can close out its position by selling an identical future contract. So you can see that if a holding future contracts, if a firm holding a future contract, then they can close it by selling this contract. Similarly, seller of future contracts can close out their position by just opposite, purchasing a currency future contracts with a similar settlement date. So these are the process to close down. Currency future market. The gain or loss to the firm is dependent on the difference between the purchase price and sales price. That we know the spread is difference between the ask price and sales price. The price of future contracts changes over time according to the movements of the spot rate and also by changing expectation about the spot rate on the settlement date. So most currency future contracts are closed out before their settlement date. Now this is the process how we can calculate margin requirement. Each currency future contract represents an agreement between a client and the exchange clearing house. Even though the exchange has taken no position and the contracts are granted by the exchange clearing house. So margin requirements are imposed to cover fluctuations in value of a contract. This means that the participant must place a deposit with their respective brokerage firms when they take a position. If the value of a contract declines over time, the buyer may be asked to add the initial margin. And the corporations that have open position in future currencies can use future contracts to offset such positions. The future contract holder locks in the price at which a firm can purchase a currency. Now I'm going to discuss the currency options market. That is very much interesting topics. A currency option is another contract that can be bought or sold by speculators and firms. So that can be buy contract or that can be sell contract. The standard options that are traded on an exchange through brokers and granted. Margin is required to be maintained during the life of the options contract. That protects against possible losses if clients do not fulfill their obligations. In contrast, the options that are tailored to the specific needs of the firm are offered by the commercial banks and brokerage firms in an over-the-counter market, that is dealer market or third market. So currency options are classified as either call option or put option. Call option is for buy contract and put option is for sell contract. What is currency call option? A currency call option is a contract between a buyer and a seller, and a currency call option grants the right to purchase or buy a specific currency at a specific price within a specified date. So the buyer of the call option gets the right to buy or sell a fixed amount of underlying currency at a predetermined price or before the expiration date. The buyer of the option is not obligated to buy or sell the underlying currency. That is the right, that is not obligation. So the price of the option known as the premium and the predetermined price known as the strike price and exercise price. And what is the spot price? Spot price is immediately exchange price, that is called spot price. So in call option, there is three things: in the money, at the money, and out of the money. What is in the money? In the money is when the present exchange rate exceeds the strike price, then that is called in the money option. Then the option will be, call option will be profitable. And what is at the money? At the money is when the strike price equal to spot price. So that is called at the money. And what is out of the money? Out of the money is just the opposite of in the money. That means when the strike price is greater than spot price. So that is called out of the money. So in currency call options, premiums of call options vary due to, number one, the level of existing spot price relative to the strike price. The higher the spot rate relative to the strike price, the higher will be the option price. This is because of the greater possibility of the future exchange rate to be more than the strike price. Number two, the length of the time before the expiration date. It is generally expected that spot rate has greater chance of rising above the strike price if there is no longer period of time involved. As such, the longer the time period, the higher the option price. Number three, the potential variability of the currency. The greater the variability of the currency, the higher the profitability that the spot rate will be above the strike price. Thus, more volatile currencies will have higher call option prices. So corporations can use currency call options to cover their foreign fluctuations. So corporations can use currency call options to cover their foreign currency positions. We already know. Unlike a future or forward contract, if the anticipated needs does not rise, the firm can choose to let the option contract expire. The firm can also sell or exercise the option. So we already discussed that it is the right. It is a right. It is not obligation. For every buyer of a currency call option, there must be a seller. A seller, sometimes called a writer of a call option, is obligated to sell a specified currency at a specified price up to a specified date. So speculators may sometimes want to sell call option in a currency that is expected to depreciate in the future. Now, individuals may also speculate in the currency options market based on their expectations of the future movements in a particular currency. That means for dollar, yen, rupee. When brokerage fees are ignored, the currency call of buyers' gain will be equal to the seller's loss if both the parties begin and close out their position at the same time. So the purchaser of a call option will break even when the spot rate at which the currency is sold equal to the strike price plus the option premium. So that is the break-even point. Now the currency put option. What is currency put option? A currency put option grants the right to sell a specific currency at a specific price within a specified date. So in currency put option, allow the buyer of the contracts to sell the underlying currency at the strike price or exercise price. So put option is mainly basically for a right to sell the currency. The buyer is expecting the spot price to fall and the seller is expecting the opposite. So the buyer will exercise the put option when the spot price S is lower than the strike price. So put option allow the buyer of the contract to sell the underlying currency at the strike price or the exercise price. So in put option also there are three things: in the money, at the money, and out of the money. What is in the money? In the money when the present exchange rate is less than the strike price. And at the money is when the present exchange rate is equal to the strike price. And what is out of the money? When the strike price is greater than the present exchange rate. So currency put options, premiums of put options vary due to, number one, the level of existing spot price relative to the strike price. The lower the spot rate relative to the strike price, the more valuable to be the put option. Since there is a greater possibility that the put option will be exercised. The length of time before the expiration date, number two. So the longer the time is to expiration, the greater will be the put option premium. And the number three is the potential variability of the currency. The greater the variability of the currency, the higher the probability that the spot rate will be above the strike price. So that create more volatile currencies will have higher put option premium. So corporations can use currency put option to cover their foreign currency positions. Individuals may also speculate with currency put options based on their expectations of the future movements in a particular currency. So that's all for me.